go.
Streaming from South Africa to the world. This is the Stonks Go Moon podcast. What just happened? We break it down so you don't have to.
Welcome everyone to the Stonks Go Moon podcast. Today, another very special guest. I've got Joseph Lackland. He's the Chief Investment Officer, Futures and Commodities at Sub4 Capital. Joseph, how are you?
I'm pretty good, Rocco. Glad to be here. Good to be on the show with you today.
No, it's my friend. It's such an honor having you. I love our conversations on LinkedIn. I thought let's bring it over to the pod. I want to ask you, first up, how did you start? How did you get into trading, and what advice would you have for someone that's looking to maybe get into trading and investing?
So when I started in the markets, I was 18 years old, fresh out of high school. I found myself on the floor of the Chicago Mercantile Exchange running orders and cards for a desk operation outside of the S&P 500.
Oh, wow. That's very cool.
Yeah, I have about 20 some odd years. I think this is my 22nd full year in the industry. And wow. When I started, it was open outcry. You know, electronic trading was just starting to become popular with the introduction of Globex and E-mini S&P 500 futures. We were some of the first people to see those things actually trade.
So you were still in the pits, right?
Yes, that's correct.
What was that like? Because I hear a lot of people talking about the pits and how great it was and people actually missing it. What exactly was the atmosphere? What was the feeling inside, like being there in the pit?
It was like being in a Viking War mosh pit.
That's
people
awesome.
Screaming and throwing stuff at each other and paper flying around, and the emotions were really in your face all the time. You know, we would stand shoulder to shoulder on the edge of the pit and take orders from the desk and turn our heads to our brokers so that they could execute the orders. I mean, it was old school. It was pretty interesting. It was a good learning experience.
Yeah. Sorry. Okay, cool. And from there, you just sort of gravitated. You were talking about high frequency trading or algos coming in and stuff like that.
What happened is when I started trading, I was leasing a seat on the exchange. I was 22 years old at the time. I was trading with a couple of guys up in the office. We were some of the first people to actually trade these things on computer full time. So a lot of the floor traders continued to trade on the floor. We traded upstairs in the office. And I did that for a number of years. I traded for myself. Then I, went to a prop shop. I figured, with more leverage and more money that, I would do better. And no, that was not the case. That was pre-2008. And then as soon as 2008 hit, the market changed significantly, obviously, with the reintroduction of stimulus programs, market-saving programs. They had QE and Operation Twist and Operation Twist 2 and, all sorts of financial engineering to cover up the fact that the housing market had completely collapsed and that all the banks and the institutions that had been selling these packages of mortgage-backed securities and things of that nature had fallen.
Yeah.
Had fallen hard. And the whole industry was in major trouble. And, to avoid a major, banking failure. I mean, we had a banking crisis. We didn't have a banking failure.
Yeah.
The credit market didn't freeze, there was still money moving around, people were still able to get in and out of stuff, but we didn't have a full on, freeze. We had a crisis.
Yeah, I'm with you. But I mean, you came through that, right? You came through that on the other side.
I came through that. And when I went back to the exchange in 2011, I decided that point and click trading was not the way of the future. This was not how you were going to be able to realistically survive. So I started to learn how to write software programs. Most of the trading language is C++, C#, .NET, Java. I chose C# because it was the language of the trading platform that I was using at the time, the NinjaTrader platform, and I've stuck with it ever since.
Yeah. And then today, here we are. I mean, in a high frequency environment, accurate levels to almost, I would say, single, sometimes double digits. I mean, it's actually quite amazing.
The market is uncanny at remembering what happened. And I'm not so sure if it's a self-fulfilling prophecy or if it's just, how the nature of the market is, like plants grow with, precision to Fibonacci ratios and stuff like that. I think the price action, in here is kind of the same way. Like it seems like a random walk and it seems, like things just happen for no reason. But if you zoom out, sit back in your chair and look at the chart, you can kind of see how the market remembers what happened on any given day. And when the market returns to those levels, it's not going to behave the same way every time, but at least you have a pretty good idea of where the interest is.
That's such a good point, because I have here written down trading mantras. And for me, every trader that's worth his salt at least, should have a trading mantra. How important is it for you? And if you can share with us, like, what is your trading mantra?
So I have a couple of trading mantras that have stuck with me over time. Some of them I've learned from, trading veterans that have twice as many years in the business as me. And one of my favorite ones is the trend is your friend. And you want to ride that trend until the very end, if possible. Another mantra is, never turn a winner into a loser. If you put on a trade, you have your initial risk, right? But once it moves a certain amount in your favor, you don't want to have that trade turn into a loser. You want to reduce your risk so that you don't get knocked out on your max if the market reverses, or you move your stop to break even. Now, depending on what you're trading, the dead break even stop could cause you to prematurely be forced out of certain situations. So my compromise is a reduction in risk. Market's going my way, I reduce my risk, maybe 50% of what my initial risk is, or 25% of what my initial risk is. And then when it hits, my first profit target, then maybe I'll, put it to break even, or I'll use, some sort of trail.
Yeah.
Now, the veterans that I know, they don't use a trail and they don't use break-even stops. Now, I haven't been trading for 40 years, so I can't trade like them. Maybe one day I'll get up to that point, but never turn a winner into a loser if you can avoid it.
But I think that's excellent advice, because, I mean, me and you, we speak often about, okay, let's say we going from, let me look, 13,800, and we say, okay, this thing is, the NQ is going 13,400. Once it gets to about, like, let's say 13,600, we say take half off. Why do you need to put everything on? And just in case it turns. I think we take half off, you take a quarter off, or you take 3/4 off, or whatever. I just think that's very good risk management. And as a mantra, I think that makes sense. Instead of keeping the whole outside to reach target, it's sort of an ego thing, don't you think?
I think that if you're going for the all-in play on every hand, just like in a poker tournament, you don't get the all-in hand every time. You don't get pocket eight every time. You don't get pocket kings every time. Sometimes you get 7-2 offsuit, and then the flop comes up, 7-2-7, and you flop the full house. Well, you didn't start with, something significant, but you just flopped the full house. And then, somebody else may, have something that you don't see. You have 7-2 offsuit, the flop's 7-2-7, and then another 2 comes up, and then you have to think about, what the possibilities are.
Yeah, what's the
You know,
possibility of a fucking V pick up 200 against you? I mean, it happens. And at least then you're like, okay, well, I didn't win. I basically I cut my risk.
yeah, you definitely want to, if you can trade multiple units, I would definitely recommend trading multiple units in this market. If you can't trade multiple regular NASDAQ or E-mini S&Ps, they have micro futures, and you get 10 micros for every one lot. And what that'll do is that'll help to reduce the drawdowns. When you trade multiple units
Yeah.
and you steal out of your winners, you don't make as much money as you would all in, obviously. But if you look at your drawdowns, the scaling exit strategy significantly reduces your drawdowns, and that will keep you in the game longer. If you're just a wild, wild west cowboy and you're all in and you're firing from the hip, I mean, that's going to work and you're going to have some big days. But when you go through a draw period and the market's out of phase or you're just not feeling it, you're going to get crushed.
Yeah.
And it's not good for your psychology. So if you can, trade with the trend. If you're a trend trader, there are some monster trends in here that they're not easy to catch, but, just like the tuna fisherman off the coast, you don't need too many of these to feed the village.
Yeah.
You don't need to catch 10 tunas in a day. They weigh, a couple 100 pounds a piece. You just need to catch one every couple of days.
No, I feel you. That's a nice segue to sort of what is happening in the market at the moment. Quickly, your short to medium term view, let's take to maybe US indices.
So, excuse me. So it's happening.
Sorry, did I make you cough thinking about the market?
Yes, exactly. I felt
you felt ill.
Yeah, I felt a little sick. I'm a little dizzy. I may have to go to the bathroom and purge the disease from my body from watching this over and over and over again. So, I mean, what's happening is that I heard a statistic the other day, and basically what it was is that roughly 40 to 45% of all the United States dollars in circulation have been printed in the last 18 months. Yeah. So we have an unprecedented amount of money that is flowing around in the economy. There's relatively little value. Housing market's in a bubble. Stock market is in a bubble. The bond market is in a gigantic, super, mega, hyper bubble.
Krispy Kreme is launching an IPO. I mean, come on.
Right. And we have things like Dogecoin that nobody even knows what it actually is, worth billions of dollars. I mean, you have the big cryptocurrencies gaining some serious momentum here. Bitcoin, Ethereum. I believe that cryptocurrencies are intending to change how we value money and how we transact. And that may be a very good thing, but it's very hard to tell what something is actually worth in this environment, no matter what it is, your house, the gold coins that you may have hidden under the mattress, your stock portfolio, your cryptocurrency, virtual wallet. It's very hard to tell what this stuff is actually worth.
Yeah, I've got this view that things are worth what we determine they are worth, right? So like people give things value. If I have this painting and maybe I bought it for $10 million, I can only sell it to someone that's willing to pay me that money. Or the intrinsic value of things are determined by what we decide it is, if I can put it like that.
That's right. It's only what you can actually convert it for.
Yeah.
So the greater fool theory is in effect in so many different asset classes that we're all just kind of wondering, how much longer is this going to continue? There's an old commercial, I'm not going to pay a lot for that muffler. It's 20 years old. It's a Meineke commercial. And yes, your house on paper is worth X, your stock portfolio is worth X, but if you're trying to do the same thing that everybody else is doing, if everybody is trying to do the same thing, and everybody thinks that they're going to be smart enough to time the market and time the exit and they're going to be able to get out before everybody else does. If everybody's trying to do that, what happens is you get a cascading flood of sentiment all at the same time. And as we've seen in a couple of examples this year already with the GameStop fiasco, the GameStop stock was not worth $300, $400, $500. But see, the problem is that Melvin Capital over shorted it to the point where the float was so out of whack from what was actually available for them to get out that they ended up pushing the price way past any envelopes that they had calculated as far as their risk was concerned. So they had thought that, this is a stock, we'll be able to cover this thing for $100, $200, whatever. And then when they actually went to go to the market, nobody would sell. So that exacerbated the parabolic move in GameStop. And that's exactly what happened last year in the stock market in March, is that everybody started selling. And it wasn't so much the fact that, the market was going down and, things were, uncertain. It was simply the fact that everybody is trying to do the same thing all at the same time. The theater's on fire. There's one exit. Everybody's running for the exit, and not everybody is going to be able to get out. And we have margin debt at record levels. If you go to the FINRA website and look at margin debt, it's the highest it's ever been. So basically, the entire market and everything else is bought with a credit card. The banks and the institutions are swiping the Fed's credit card and purchasing assets and pyramiding and leveraging. And the more they have on, the more their numbers are marked to market and their values are reflected to the market. So that gives them more buying power. I believe in 2008, the leverage was at about 30-1.
Yeah.
We have leverage right now in excess of 75-1, probably closer to 100-1. So we have more money than ever. We have more leverage than ever. We have more greed than ever. And we have more market geniuses than ever.
This can only end well, right? I mean, there's no way. This can only end well. I mean, come on.
It took them 3 weeks last year to destroy 40% of the value of the stock market. 3 weeks. We were trading up at 3,400 in the ES. We were at 2,300, 2,400 3 weeks later. I mean, we're talking a major, catastrophe.
So, I would say, let's just make sure you are on the right side. I'd rather, and I said it last week, I'd rather sit on all cash sooner than later and make sure that even if whatever potentially I miss out on, that's fine.
You don't have to worry about missing out on anything right now. There's plenty of opportunity. You can trade stocks, you can trade futures, you can buy some cryptocurrency. You should buy some precious metals if you can.
Yeah.
You should acquire some real estate. I wouldn't recommend going to buy, any real estate property right now. There's a major frenzy going on. There's a gigantic, rush to buy property. I think that's going to come in significantly. You just want to be able to take advantage of what's happening right now. You want to diversify, and you don't want to participate in the fear of missing out. There's going to be even more opportunity when the tide rolls back out again. And we're going to see that here in the market. It's fallen off pretty good. I mean, in NASDAQ over the last 6 sessions, we've gone from 14,000 to 13,400. That's 600 points. That's nothing. There's absolutely nothing. It feels like the end of the world. 2 days ago,
it's
it
not.
felt like the end of the world.
If you zoom out, we're just going up and up and up. I mean, if you zoom in, it looks bad, but if you zoom out, it's actually nothing.
Right? So you don't want to get caught up in the hype.
Nope.
Stay vigilant and stay ready to take advantage of things. The cryptocurrency market, there's a lot of opportunity in there, but none of us actually know what this stuff is worth. We know that it may be better than central banking.
Potentially,
there is an idea that, like the blockchain cannot be hacked and it's impenetrable and it's, totally fail safe. That's not true. I have friends who are in the software industry, friends who, hack for the government. They tell me that, it's a good thing, but, you don't want to get too caught up in the hype about anything. You definitely want to have them just to have them. Like I said, you want some precious metals, and there are some good stocks out there. I don't think buying Microsoft and Facebook and Tesla right now, I don't know if that's a good idea, depending on how close you are to retirement, or if you're trying to grow your wealth in a steady fashion. This stuff is highly speculative, highly leveraged. Unless you have money to burn, and none of us really do. Over here at the hedge fund, we can't burn investor money. We have to make good decisions. So we're treating a lot of this stuff like highly speculative assets right now. And highly speculative assets are good to trade, on a short-term basis. But for long-term investing, I don't know if investing in anything long-term right now is a smart move due to the distortions that we have in the valuation.
Joseph, on that note, gonna love you and leave you. Where can our listeners find you, and what's some of the other stuff that you guys are busy with?
Well, I started a software company about 2 years ago. We have failed miserably since then, but it is a place where you can go and pick up indicators for the NinjaTrader platform. And at the time, I don't offer consulting anymore, but at the time, you could contact me for consulting and development. That was FutureScript, future-script.com.
Okay.
So you can some of the work that I do. I have some of my tools on there. You can always find me on LinkedIn. I've discontinued using Facebook and Twitter, not because I am opposed to those platforms. I just don't have much time for them between the new venture that we're doing, and LinkedIn is how I keep in touch with you guys. So best
decision ever to delete Facebook.
Yeah, it's just it distracts me. That's all.
Yeah.
It's not good. It's just distracting. And
I hear you.
Maybe if I have a crystal ball and I figure out what the golden goose is in the market that lays the golden eggs, maybe I'll have more time for distraction. But right now, I'm living in reality, and there's only so much time in the day.
Both hands on the wheel, my friend. Both hands on the wheel. Joseph, thank you so much for coming on. To the listeners, peace, love, prosperity, and we'll check you in the next one. Cheers.